There's a market out there worth more money than every single stock on Earth combined. Apple, Microsoft, Nvidia, every company on every stock exchange in every country, all added together. This other market is still bigger. You've probably never thought about it. Not once. It's called the bond market, and it has a reputation problem. People call it boring, the uneaten vegetables on the plate of finance, something you deal with later, if you deal with it at all. Here's the thing about that reputation. This boring market has ended the career of a sitting prime minister. It has broken a major American bank in less than 48 hours. It once erased over $1 trillion in 7 months, and almost nobody remembers it happened. This market decides your mortgage rate, your rent, whether your government can afford to keep spending, whether the company you work for can afford to keep you employed. And it's been doing all of this quietly, in the background, your entire life. By the end of this video, one number is going to make sense to you that most adults never learn. And once you see it, you won't be able to unsee it in the news again. Let's start with the size of this thing, because the number alone should stop you. The global bond market is worth somewhere around $135 trillion. The entire global stock market, every share of every public company on the planet, comes in smaller than that. In the United States alone, the bond market sits at around $58 trillion, and the US makes up close to 40% of the entire global total. So here's the question worth sitting with for a second. If this market is bigger than the stock market, why does it get a fraction of the attention? The answer isn't complicated. Stocks move fast and they move loud. A stock can jump 20% in a day and it's all over your phone by lunch. Bonds don't work like that. They drift. They creep. They rarely give you a reason to open an app and stare at a red or green number. But quiet doesn't mean small, and it definitely doesn't mean unimportant. Vegetables don't announce themselves the way dessert does either. That doesn't mean they're the thing keeping you alive. Here's what this quiet market actually touches: your mortgage rate, your car loan, the interest on your credit card, how much your government can afford to spend before it runs into trouble. Even the AI boom you keep hearing about is being financed, in part, through this exact market right now. None of that will make sense yet. Not until you understand one single idea. It's a seesaw, and once you see it, you'll understand every story in the rest of this video before I even finish telling it. A bond, at its core, is embarrassingly simple. You give someone money, they promise to pay you back later, plus a little extra for the favor. That's it. That's the whole concept. Governments do this. Companies do this. When you buy a bond, you're basically becoming the bank for a little while. Now here's the part almost nobody explains well, and it's the one idea this entire video depends on. Bond prices and interest rates move in opposite directions. When interest rates go up, the price of existing bonds goes down. When interest rates go down, existing bond prices go up. Picture it like this. You buy a bond that pays you a certain interest rate. A little while later, brand new bonds come out paying a much better rate. Suddenly your old bond looks unimpressive sitting next to the new one. Nobody wants your old lower paying bond unless you sell it to them for less than you paid. In real crisis moments, that gap isn't small. An old bond's payout can look 20 times worse than what a brand new bond offers. To get anyone to touch it, you have to discount it. Hard. That's not a metaphor. That's a fire sale. This seesaw is one of the most powerful forces in the entire global economy, and almost nobody outside of finance can explain it in one sentence. It has taken down a major bank. It has taken down a sitting prime minister. It once erased more than $1 trillion from the world in less than a year. Let's start with the $1 trillion. Picture 1994. Interest rates are sitting at some of the lowest levels in decades. Investors feel comfortable, confident even. The kind of confident that makes people stop paying attention. Then the Federal Reserve moves. Not by a lot. 0.25%. The kind of number that sounds too small to matter. But remember the seesaw. Rates go up, even a little, and bond prices go down. Except this time, the whole market had positioned itself as if rates would never move again. When they did, the seesaw didn't tip gently, it slammed. Within that single year, bondholders around the world lost more than $1 trillion. Companies you'd recognize immediately got caught in it. Dell, Kodak, Procter and Gamble. Orange County, California was hit so hard it was forced into the largest municipal bankruptcy the country had ever seen at the time. A Nobel Prize-winning economist named Merton Miller looked at what happened and admitted something that sounds almost funny now. He said he'd never understand why they call it fixed income, given how much of it had just evaporated. But the line that really captures what this market can do came from someone who wasn't even in finance. James Carville was a political strategist for Bill Clinton, watching this crisis humble the entire administration from the inside. He joked that if reincarnation were real, he wouldn't want to come back as the president. He'd want to come back as the bond market because, in his words, you can intimidate everybody. That wasn't really a joke. That was a warning most people missed. That was 0.25%, decades ago. Now picture a bank that thought it had found the single safest place on the planet to put its money. Silicon Valley Bank spent years flooded with deposits. Tech companies, flush with cash during the pandemic boom, parked billions there. The bank needed somewhere to put all that money, somewhere safe. They chose U.S. government bonds, the single safest asset most people can name. Zero default risk. The kind of investment nobody questions. Here's where it gets dangerous. To earn a slightly bigger payout, the bank leaned into longer-term bonds instead of short-term ones. That decision seemed harmless at the time. But remember the seesaw. The longer the bond, the harder it swings when interest rates move. And interest rates were about to move harder and faster than they had in decades, as the Fed fought to bring inflation under control. As rates climbed, the market value of SVB's bond portfolio quietly collapsed. Not because anything was wrong with the bonds themselves, because newer bonds now paid so much more that the old ones looked unattractive by comparison. Exactly the mechanic from Act 2, just playing out at a scale that could sink an entire institution. Then the bank needed cash to cover customer withdrawals. It was forced to sell $21 billion of those bonds. Not on its own terms. At a loss. A $1.8 billion loss, to be exact. Word got out fast. And once depositors sensed the bank was in trouble, they didn't wait around to find out how bad it really was. $41 billion left the bank in a single day. It became the second biggest bank failure in American history. The lesson sitting underneath all of this is simple, and it's the one most people never learn until it's too late. Safe doesn't mean risk-free. It just means the risk shows up somewhere you weren't looking. If a professional bank staffed with people whose entire job is managing risk can misjudge this seesaw, imagine what happens when an entire government gets it wrong. September 2022. The United Kingdom has a brand new Prime Minister, Liz Truss, and a brand new Chancellor, Kwasi Kwarteng. They announced the biggest package of tax cuts the country has seen in 50 years, without a clear plan for how to pay for it. The bond market's response wasn't polite disagreement. It was closer to a revolt. The yield on the UK's 30-year government bonds spiked by more than a full percentage point in just 3 days. For a market that usually moves in tiny increments, that's an earthquake. Here's where the story gets genuinely frightening because of something hiding underneath the surface. British pension funds had been using a strategy that made them extremely sensitive to sudden moves in bond yields. When yields spiked, those funds got hit with sudden demands for more cash to cover their positions. To raise that cash, they had to sell even more bonds, which pushed yields even higher, which triggered even more demands for cash. It was a feedback loop with no obvious exit. The Bank of England later admitted that without stepping in, several pension funds, the retirement money of ordinary working people, were hours away from collapsing entirely. Bankers inside the crisis were quietly calling it the UK's own Lehman moment. The central bank had no choice but to intervene directly, buying government bonds to break the spiral before it could take the wider financial system down with it. Within weeks, both the Chancellor and the Prime Minister were gone from their jobs, not because of a scandal, not because of an election, because of the bond market. The bond market didn't just move numbers on a screen that week, it ended 2 political careers in under a month. This isn't a history lesson. This is happening again right now in 2026. Global bond issuance just crossed $1 trillion in record time this year, and a meaningful chunk of that is tech companies borrowing heavily to build the infrastructure behind the AI boom you keep hearing about. At the same time, talk of bond vigilantes is back in financial headlines, as investors eye a major tax bill projected to add trillions of dollars to the deficit over the next decade. The same forces from 1994 are stirring again. And the UK hasn't fully shaken off 2022 either. Its 30-year bond yields have recently pushed past the levels seen during the worst of the trust crisis. Nobody's panicking the way they did back then, at least not yet. But the market that broke a government once is still watching closely. This isn't background noise. This is the mechanism setting the terms for nearly every major financial decision happening on the planet right now. Bonds were never actually boring. They were just quiet. And the quiet things that move $135 trillion are exactly the things worth paying the closest attention to. Most people will keep scrolling past this market until the day their mortgage rate jumps and they have no idea why. If you'd rather be the person who saw it coming, that's exactly who this channel is for. Vegetables don't announce themselves either, but they're the reason you're still standing.